almost impossible. So that's why I'm just going to focus on things that are really important, okay? And also touching questions that are really important that would come out frequently in the exam, okay? So then the rest you would have to maybe rely on your own effort, okay? Or you read on your own. If you do business studies, then you must have known the pros and cons of setting up companies very well, right? And in the business study, you are always asked to compare the pros and cons of setting up your business as sole trader, partnership, and companies, right? Okay, it's in the chapter 4 of your business study. They keep asking you what are the advantages and disadvantages of forming these three types of business organization, right? Okay, and companies, there are two types, private limited company and public limited companies. But for this accounting subject, you don't need to care. Okay, don't need to care that there are two types of companies. They will not ask you the difference between private limited and public limited companies. Okay, don't worry about that difference, the two types of companies for this subject. Now, let's just go to those parts that are important, okay, that I think important for exam. First page, you just refer to the PDF with my annotation, copy and paste those handwritings into here. I want to go to the next page. This page, 300. No choice, this table is big, so I make it appearing on a landscape mode here, okay, instead of appearing vertically. Okay, this table is important for you to answer the theory questions in the exam. Later, I will show you, okay, the related theory questions. You see, at the bottom of my screen in the middle, 54 pages, a lot of pages. Reason is I have gathered a lot of companies' question into this single PDF. If you want to guarantee that you would not see any problems that could challenge you in the exam for this topic, then you finish off all the questions in this handout. For sure, by that time you would have mastered this whole topic. Okay. All the questions in this handout, they are past exam question. Okay, now let's focus on this one. A very common question in the exam is about they ask you to compare three things. They ask you to compare ordinary share, vs preference share, and lastly debenture. I believe if you have gone through enough past exam papers, you know what I mean. Okay, you should have come across many questions that ask you to compare these three things: ordinary share, the preference shares, and debentures. Okay, later we will go through some and we try to answer together. Now, do you have highlighters of different colors? If you have highlighters, if you have many different highlighters of different colors, then you do the same thing as I'm doing here. I'm not going to read through all these sentences with you here, okay? I'm just going, you can see, right, this table, there are two types of shares. The two columns on the left, they are about ordinary share, okay? The pros and cons of ordinary share. And the two on the right, the preference share, okay? The pros and cons, okay? The pros and cons of preference shares. And now I'm going to use yellow color to highlight all those lines that are related to one another so that you can see the comparison more easily. Okay, because I didn't have time to structure the table again to put all the lines that are about the same thing in a single row. Okay, so I'm going to use highlighter. The ones in yellow are related ideas. Okay, the related ideas. Okay, for example, voting rights. Preference shareholders don't have voting rights. Ordinary shareholders have voting rights. Usually, I would explain what is meant by voting right. If I have time, I explain to you. Yeah, okay, voting rights. I believe you have heard of it before. Then use a different color. Now I'm going to highlight another idea. I use pink. It's about the dividends. Okay, variable rate of dividends. For ordinary shareholders, they receive variable rate of dividends. And For preference shareholders, they receive fixed dividends. Okay, can see the one in pink. Okay, they receive fixed dividends. So if a question asks you for the difference between ordinary share and preference share, this is a good point to write. Very easy to write. Ordinary shareholders receive can see variable rate of dividend. Okay, on another hand, preference shareholders, they receive fixed dividends. Voting rights is also something very easy to write. Ordinary shareholders, they have voting rights. Preference shareholders, they don't have voting rights. Okay, and now let me continue to do the highlighting. Okay, you may do the same. Okay, if you have many highlighters of the same color, when you do the highlighting, you can easily see the relationship between the lines here. Okay, now I continue to highlight. Okay, this is about fixed dividend as well. And then this is about dividend as well. You can see, right, for each of the sentence here, you have a single word that is bolded. Agree? For example, you see that you have a shareholder here that is bolded. It means that it is under the disadvantage column, right? It means that this entire paragraph is about a disadvantage to the shareholders. Okay, that's why I have bolded the word shareholder. And the same, that's how you interpret for all the sentences here. For example, you see shareholder here, that means it's an advantage to shareholder. You see you have a word company here that's bolded, that means this is a disadvantage to the company. Okay, that's how you see the paragraph. Yeah, the bolded word is the party that is important in that sentence. Okay, now I continue. This is also about dividend. Okay, and then I'm going to use a different highlighter. Okay, this is also about the dividend, but a disadvantage to the company. Okay, don't worry. I will show you some questions. I will guide you on how to apply whatever that is in this table to the questions. Okay, now I'm just going to do the highlighting, and later I show you how to apply. Okay, this is about company closing down. Okay, you must know what happens when a company closes down. Later, I will give you a summary for this one. Okay, company closing down, what would happen? Okay, this one, orange. Okay, about company closing down. And then, okay, another color, green color. This is about the priority in getting dividends, priority in getting dividends. Okay, and then there's one line that is independent. Dilution of ownership for the existing shareholder. Okay, dilution of ownership means you have a lower level of power. You have a lower level of ownership for existing shareholder. It means that you add a few words here that I have left out. You write after issuing more share. After issuing more shares. When the company issue more ordinary shares, there will be dilution of ownership to the existing shareholder. Okay. And okay, more on that. I don't talk about dilution, okay, because it's a very long story. I just focus on those things that are important. Okay, now I want to explain about liquidation. Okay, there's some space at the bottom, right? You write liquidation. Liquidation, you must know the meaning. Liquidation, it comes from the word liquidate. Liquidate. Okay. Liquidate in Mandarin, we call it the 动词, right? Liquidate is the 动词, and the liquidation is the 名词. Okay, kata kerja, kata nama. So when you see this word, it means company closes down. Okay, company closes down. So there's one more word. There's one more word, which is the synonym, winding up. Okay, these three terms mean the same thing: liquidation, closure, winding up. These three words mean company closing down. Okay, so why would a company close down? Probably has been making a lot of losses. And you can see there are many hotels in Malaysia that have closed down due to the COVID-19 and all the yeah, all the cases are very serious. That's why hotels keep closing down, right? Okay. Now my point is I'm going to show you a sequence of events that would happen when company closes down, and then you write together with me. This is the about those lines that I have highlighted in orange color. About those lines that I have highlighted in orange color. Can see closes down. Okay, when company closes down, what happened? And then here you have the word my winding up. Okay, now let me show you, and then you write together. First thing that would happen is, you see, when you have closed down your company, do you still have any use to the assets in the business? That means, do you still have any uses to those assets you have in the business? No, right? You should sell them off. You should sell off your assets. Okay, so we should sell off all NCA, agree? Okay, for example, you have a factory, inside there you have a machinery. Is there any use to it anymore when you close down your company? Of course, no. Sell off all your NCA. And what about current asset? Current asset, you have you could have trade receivable, right? You can have inventory, right? You can have cash and bank, right? Okay, so just now I talked about the first step. You would sell off all your NCA when your company closes down. How do you deal with the current asset? Okay, first one, trade receivable. Trade receivables refer to customers who owe us money, right? Customers who still owe us money. What do you do with it? Chase them for money. Okay, chase them for money. Agree, right? Okay, because you want to close down your business. Of course, you try your best to collect as much money from them as possible. Chase them for money. What do you do with inventory? Inventory is goods. You do clearance sales, right? You do clearance sales. Basically, what you are doing here is you are trying to sell off everything. You want to clear off everything in your SOFP. Okay, chase them for money. You want to clear off the trade receivable. Inventory, you do clearance sales because you want to clear them off as well. Eventually, you want to have just money that remain in your business. Agree? Okay, you want to turn everything into money. So these are what remain after you have cleared off all the NCA, clear off all other current assets. Okay, these are what remain after you have cleared off all other assets. So after that, what happened? Now, you look at your SOFP again. Once you have cleared off all the assets, turn all the assets into cash and bank, you have to clear off the liabilities as well, right? Liabilities are those debts you owe to outsiders, debts that you owe to outsiders. You have NCL, you have CL, must clear them off. Okay, so let's continue to write. So just now I talked about first step being selling off all the NCA, and then second step, try to clear off all the current assets, turning them into cash and bank. Okay, so and then finally, cash and bank are what remain. Then third step will be to pay off all the liabilities. Agree, right? Okay, you must pay off all your liabilities. Try your best. And who are the people? What do we call them as? What do we call the liabilities as? Creditors, right? People whom we owe money to them, we call them as creditors. Okay, so you must pay off to these creditors, pay off all the liabilities to these creditors. And if there's still money left, after paying off all the liabilities, what do you do with the money? After you have paid off all the liabilities, you should try to return back the money back to the owners as much as we can. So you write event number 4, you would return all the money back to the owners. Who are the owners of company? Shareholders, right? There are two types of shareholders, ordinary shareholders and preference shareholders. So who do you think would get back the money first? Should be preference shareholders, because preference shareholders, you see, there's a word preference, right? Preference means they must have some form of priority, preference, preferred. Okay, preference comes from the word preferred. So if If somebody buys preference share, you call that person as preference shareholder. If somebody buys ordinary share, you call that person as ordinary shareholders. So you have two groups of owners, two groups of shareholders. Who would get back the money first? It is, just now I mentioned, or preference shareholders first. Okay, so you write preference shareholder first, then only ordinary shareholders would get back their money. So now we can establish a priority. We can establish a priority about who would get back the money first. You see, there are three groups of people here. There are three groups of people here in this flowchart that you have just drawn. First group of people, creditors. Second group of people, preference shareholders. Third group of people, ordinary shareholders. Now, who would get back the money first when company closes down? Creditors. Creditors have the right to get back money first. Okay, then only followed by preference shareholders, then followed by ordinary shareholders. Okay, so this is the sequence based on the law of any country. Okay, if you ask me why we have this sequence, I also don't know. Okay, this is the norm. This is the norm. Okay, we just follow. Creditors get back money first, then preference shareholder, then ordinary shareholders. So you could be thinking. So if you are the kind of people who think out of the box, you could be thinking, is it possible for any one of them to not get back their money? Because you see, in the first place, when you close down your company, there must have been some problems in your company, right? In your business, right? Which makes you want to close down your company because it's not doing good. It's not doing good. So yes, you are right. It's very possible for some people to not get back their money, especially the ordinary shareholders. Ordinary shareholders, they are the least preferred, right? They are the last group of people who get back their money. So if all the preference shareholders have gotten back their money, and if there's no money left, then the shareholders will not get back their money. That's what we call as they have lost their investment. They have lost their investment. You have heard of people buying shares and then they lost all their money? Yes, right. This is what happened. Okay, the company closes down and some ordinary shareholders don't get back their money. Okay, so once again, it depends on how much money you can generate from selling off your NCA, from chasing from trade receivable and doing clearance sales. Okay, it depends on how much you have here, the cash and bank. Okay, pay off to creditors first, then preference shareholder, then ordinary shareholder. That's the priority, the sequence of priority. And this is about the two sentences in the table. Yeah, these two. Okay, you can read on your own. When company closes down, shareholders are only entitled to claiming back their invested capital. After the PSC stands for preference shareholder. Preference shareholder, okay, PSC holder, have made their claim first. That means preference shareholders get back their money first. And here, capital is repaid to, when you see the word shareholders here, whether it is preference or ordinary, you see this sentence is under which column? This sentence is under preference share capital column. That means the shareholder here is about preference shareholder. Okay. When you see that this word shareholder is under ordinary share capital column, it means that we are talking about ordinary shareholder here. Okay. You know how to read. Yeah. If you have problem, you let me know afterwards. Okay. So this is about the priority when company closes down. Now, look at the ones in green. Very soon we are going to the question. Okay. Now we look at the ones in green. It's about the priority of getting dividends. Preference shareholders receive dividends out of profit for the year prior to ordinary shareholders do. Prior to means before. Not sure if you know that word. Prior to means before. That means the same goes to dividends. Whenever company pays dividends to shareholders, preference shareholders will always get the dividends first. Okay, once again, it is in compliance with the law of the country. Okay, preference shareholders will get dividends first before ordinary shareholders do. That's why it is an advantage under preference share capital column. On another hand, this sentence, ordinary shareholders would only receive dividends after preference shareholders have received theirs. Okay, the other way around, this is a disadvantage to to the ordinary shareholders. Okay, so that's how you read this table. That's how you read this table. Now I show you some questions. We answer together. Very easy. Don't worry. Okay, how to apply this table to the questions. Now I go have a look at questions. I don't have a choice. I have to try to speak fast. Okay, I try to speak fast. If necessary, you have to rewatch the video. Okay. Oh yeah. Okay. Now page 308. 308. Okay, come to 308. We write the answer together. Okay. Question F. We are going to look at question F. Okay. State two ways in which ordinary shareholders may be affected if NECO Limited. Okay. How do you know whether you are doing a company's question? You have to look for the word limited. If the business name is together with the word limited, that means you are doing a company's question. That's how you observe. Okay. If NECO Limited raised the additional funds by issuing preference share. So you try to imagine when company issue more preference shares, issue also means sell, okay? Not sure if you are aware. Issue shares also means sell shares, okay? Sell shares to investor. Why company wants to sell shares? Why company wants to sell shares? You can refer to the first page and read on your own as to when will a company issue share. Okay, this is on the first page where you have where you see a lot of pizza here. Issue also means sell. So when will a company issue share or sell share? When they need money. When do they need money? When they are starting the company, or when the company wants to expand their business, or when they have insufficient money in the business, having a lot of liabilities, okay, a lot of liabilities, or they have been making losses. Okay, very easy. When will a company issue share? When the company needs money. Yeah, now get back to that question. We focus on that. Okay, this one. Now, before I answer this question, I read this paragraph on top, must be relevant. Directors, you know who are directors, right? You learn business study. Directors are people who run the business of company. Only companies have directors. Sole trader business, partnership business, no directors. Okay, directors are the workers of shareholder. Shareholders, every year shareholders, they have a meeting known as annual general meeting. Okay, AGM. This term is in your business studies textbook. Annual general meeting. In this meeting, they will try to vote for next year's panel of directors. That means it's like election. It's like a country's election. In Malaysia, when you have election, you vote for politicians to run the country, right? You vote for who are the politicians to run the country. In company, in this AGM, they do voting. They vote for what? They vote for who are the people who would become the directors of the company to run the company. Okay, let me repeat. Yeah, in AGM, they would do voting. Okay, they would do voting, and they vote for who would become the directors for the next year to run the company. Okay, so directors are like politicians. Okay, directors are like politicians in the company. So it says that directors wish to raise additional funds to finance a program of expansion. They want to expand their business. Okay, expand business, right? Considering raising 60,000 by issuing 5% preference share. Now, you may have a question. Why issue preference share? Why don't they issue ordinary shares? Why don't they borrow money? Is a very good question. In the future, if you study a subject known as finance, finance means you are trying to raise money. You are trying to raise funds. And you are going to study in details the many options to raise money in a company. And then you have to compare the pros and cons. Then you make a conclusion. That's a complex topic, okay, that we'll study in the future if you do business-related course. So assume that this is the best option. Okay, they are considering to issue preference share. 5% means what? That's the name of the preference share. When you see preference share in questions, you always have a percentage attached to it. 5% is the fixed dividend. fixed dividend that preference shareholders get. Don't ask me why it's 5%, why not 10, why not 11. It is decided by the company. Okay, it's decided by the company. So this is the fixed dividend. Whenever you see the name of preference share, the percentage that is attached is the fixed dividend that preference shareholders get. Now, how to answer this? When you issue more preference shares, it means that there will be more preference shareholders around, right? There will be more preference shareholders around. What does it mean? It's a big issue to the ordinary shareholders when it comes to company closing down. Remember, company closing down? When company closing down, preference shareholders will get back their money first. If there are many preference shareholders, then the chance of ordinary shareholders getting back their money will be very low. Can see the link, okay? The link to the notes there just now. Okay, now I write and then you try to read. Yeah, now let's write together. Here you write together with me. I start to write, then you write. Try to write faster, yeah. Claiming back means getting back again. Okay, I know it's very lengthy, but don't have a choice. Okay, in order to make the answer look complete, I have to write it as long as this. Okay, they will have a lower chance of claiming back their investment. Okay, I left out a word. During company's liquidation. Okay, ordinary shareholders would have a lower chance of claiming back their investment during company's liquidation due to the more preference shareholders around. Okay, so my first answer is about liquidation. Second answer, I'm going to talk about the sequence of the sequence of priority, in getting dividends. Remember, preference shareholders they get dividends first, right? Followed by ordinary shareholders getting their dividends. Okay, preference shareholders will get their dividends first, then only ordinary shareholders get their dividends. That's the priority. So you try to think once again, when there are more preference shareholders around, that means more dividends to be paid to them, right? More dividends to be paid to the preference shareholder. And do you think that company would pay a high dividend to the ordinary shareholders? It's quite likely that they will get a lower dividends because a lot of money have already been paid to the preference shareholder. Because preference shareholders, they get fixed dividend. Okay, they always get fixed dividend. It's always fixed. Cannot be lower, cannot be higher. It is the 5%. So if there are a lot of preference shareholders, it means that company has to pay out a lot of money to the preference shareholders. So quite likely that ordinary shareholders will receive a lower dividend because for ordinary shareholders, they receive variable rate of dividend. Variable means can be 0% to any percentage, Okay, it can be any percentage. So that means it can be 0. So can see the effect. Yeah. Now let's write together. Let's write together. Okay, you may have an issue with writing such an answer in the exam, but if you have done enough questions, then you would know how to write again. It's always the same thing. It's always the same thing to such a question. Okay, now let's write together. Ordinary shareholders Okay, when you're done writing, you let me know in the chat box there. Then we move on to the next related question for you to apply the table that you saw earlier. Okay, I wait for you. Okay, yeah, good, Cherry and Joey. Okay, good, Okay, good, Jing Jing. Okay, so if you want to refer to mark scheme to see how they wrote the answer for this, then you can go to the PDF. You remember in the WhatsApp group there, I sent all the answers to you, right, in PDF. So if you want to see how they wrote for this, then you can refer. It's the same thing as I wrote here, but maybe my description here is more detailed. Okay, you can look at it yourself when you are free. Okay. Now, next question. You see, even though you see company's question here, most likely that it would be linked, it will overlap another topic's question. Okay, it will overlap another topic's question. An example is here. You see, this is company's question, but you have fixtures and fittings account to do related to depreciation. Okay, so that's almost always the case. You will see overlapping of topics in any question. Now let's move on to the next one. Mm. Hino is asking me a question whether it is possible to switch from being ordinary shareholders to preference shareholders and vice versa. Yeah, possible, but I do not know how that happens. Okay, because it's outside our scope. It's possible. You just have to sell off your ordinary shares, then you buy preference shares. Okay, but I do not know how is the process. Okay, so I cannot tell you how, but it's possible. Maybe you can search it up online. Okay, page 324, page 324. Another relevant question, page 324. Okay, so it's good that all of you are inquisitive, asking all these questions. Okay, that means you see yourself having an interest in the subject that may help you to decide what to do in the future. Okay, in the university. Okay, so page 324 state two ways in which existing ordinary shareholders may be affected if an issue of preference shares is made. Is this the same question as the one just now? Answer is a big yes. Same question. So when you are free, just copy and paste from the earlier question, okay, into here, the same answer. One, you talk about the liquidation, and then another one, you talk about the dividends, okay? So why do I bring to you here? Because I want to show to you how important this question is, how popular this question is. So you see, it's very possible for such a question to come up again. The one we saw just now is in 2016, question from 2016. This one is from 2018. So is it possible to come up again in 2021? Very possible. Okay, very possible. A very popular question. Now, next page, you look at question C. This is a different question. Okay, two ways in which the existing ordinary shareholders may be affected if an issue of additional ordinary shares is made. Okay, this is between new ordinary shares and old ordinary shares. Shareholders. Okay, existing ordinary shareholders means those old ordinary shareholders. Okay, those who have been ordinary shareholders for many years. And so what is the effect? First thing you may write is dilution of ownership. Dilution of ownership. So you write dilution of ownership. Okay, 3 words will do. You can get the marks. Okay, I think I better spend 1 to 2 minutes to talk about dilution later. Okay, I go back to the notes and talk about dilution. Second point, you talk about dividends. Dividends. So you try to imagine when there are many or when there are many more ordinary shareholders, agree, right? When you issue more ordinary shares, that means there will be more ordinary shareholder, right? There will be more ordinary shareholders around. So quite likely that each of them will get lower dividends. Okay, each of them will get lower dividends because company has to think that there are so many people to pay, I should pay a lower amount to everybody. Okay, if there are not many ordinary shareholders, maybe I can pay a bigger amount. So let's write the second point about this one. in more professional terms, here. Okay, let's write. You write okay. Okay, when you are done, you let me know in the chat box again. Then I go on to explain dilution of ownership. Okay, still have 50 minutes. Okay, about 15 minutes. Okay, good, Joey. Okay, good. Okay, wait for Jingjae. Okay, good. So I believe that for the earlier topic that we discussed, the manufacturing account, none of you have asked me any question, okay, throughout last week. So I believe that that topic is very much easier to understand, right? Okay, that's why none of you have any question about it. Okay, now, sorry, we have to get back to the notes. Flip to the earlier pages, many pages earlier. You look at the first page of the company's note section. Here, where you see a lot of pizza. Okay, it is this page where I talk about the dilution with students. Okay, you always think of a company as a pizza. You try to always think of a company as a pizza. Okay, and if you own a slice, okay, you can see, right? This pizza has been cut into 8 slices. Can see? Of course, from your book there, you cannot see easily. Here you have color, you can see easily. There are 8 slices in total. Okay, if you tell me that you own the whole pizza, you own the entire pizza, that means that you own the whole company. Logical? Logical, yeah. Okay. If you cut the pizza, okay, pizza means company, company means pizza. If you cut the company into 8 slices, that means that there are 8 shares altogether. There are 8 shares altogether. So that means I can say that when the company issue more shares, the pizza will be cut into more slices because more owners will share this same pizza. More owners will share this same pizza. Okay. Only one pizza, yeah. One company is one pizza. Okay, think of it this way. So one slice represent a share. One slice represent a share. Now, and here in this pizza, you have 8 shares in total. That means company has issued a total of 8 shares. Now, I want to explain about dilution of ownership, right? Okay, you see, the original eight slice pizza, imagine that you only have a slice. You only own one slice of the eight slice pizza. So how much is your power? Power means how much do you own in the company in terms of percentage. You take 1/8 times 100, then you will know what is your power, your ownership level in the company. I think it's 25%, if not wrong. 12.5%. Okay, so that's how you calculate your ownership level of a company. But don't worry, in the exam, you don't have to calculate such thing. Okay, so based on this, you own 12.5% of the company. Okay, and you see an arrow here in between. An arrow here, you write issue more shares. Issue 8 more shares. Okay, you write issue 8 more shares. So like I mentioned earlier, when the company issue more shares, it means that the same pizza would be cut into even more slices. That means each slice would become smaller, right? Okay, I know the left picture and the right picture don't look like the same pizza, but I cannot get anywhere where to get the same kind of pizza. Okay, on the left, these two pictures I got them from online. So when company issue 8 more shares, it means that after that the pizza is now having 16 slices. Originally there are 8 slices. When company issue 8 more shares, the pizza now becomes having its 16 slices. You try to imagine, if you still own just one share, your power would become lower. So you try to calculate 1 over 16 times 100. Okay, now calculate. 6.25%. Now you see the effect. Okay, for those who like to do a lot of thinking, then you have an idea. How can I maintain my level of power? I have to buy the same proportion of shares when the company issue more shares. But there's something outside our scope. Okay, here I just want to demo to you what is meant by dilution of ownership. Originally, before company issue more shares, you own one slice. After company issue more shares, you still own one slice. That means you don't buy more. You don't buy more shares when the company issue more. It's going to make your power lower from the original 12.5% to the later 6.25%. This is known as dilution of ownership. Okay, so yeah, that's dilution of ownership. The lowering of the power of you in the company. You own less of the company. Dilution of ownership. Don't get this mixed up with chemistry, okay? Dilution in chemistry means, imagine you have a cup of Milo, you pour more water into it, it becomes diluted, right? Tasteless, right? When you pour more water into your Milo. But here, dilution means your power becomes smaller. Okay, dilution of ownership. Okay, let's get back to that. We have more to do. Okay, if you have question about that, you let me know later. Let's get to a question. The one that we saw just now is here. Okay, now next question I want to try with you is, here, 327. Okay, define each of the following terms. You see, these are all past exam questions. It's very possible for them to ask you for the meaning of shareholder, the meaning of limited liability. Limited liability is a very popular term for business exams. Okay, I believe you are aware if you do business study. Okay, so you know the meaning, right? Okay, let's try together. Let's try quickly. Don't forget to look at the mark allocation. That can give you some hint as to how much you should write. Here 1 mark, here 1 mark. Okay, there's no such thing as half mark. Okay, there's no such thing as half mark. Don't worry. If you think that if you think that you have not written much, don't worry. You will not be given half mark. No such thing as half mark. Okay, so now write together. Also, don't worry about the lines they have given you here. They have given you 3 lines, right? Does it mean that you must write 3 lines of answer? No. Okay. You write the owners of company. The owners of a company. Okay, as simple as that. Okay, owners of a company. And then limited liability. I don't want to explain this one, okay? This one I think you know very well. Limited liability. It's about the shareholders' loss is limited. Very simple. Limited liability means, for example, if 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 somebody known as Ali, Ali has bought 10 shares of a company. Okay, maybe 10 share of Apple company, Apple is a US company. Ali bought 10 shares of Apple company, $100 each. That means Ali has spent a total of $1,000, right? Okay, to buy 10 shares of Apple. So this is the maximum loss to Ali. Okay, imagine that Apple closes down, all the iPhones, iPads, all the MacBooks don't sell very well, so they close down their company. This will be the maximum loss to Ali. Okay, because Ali paid a total of 1,000 to buy all the 10 shares, right? That will be the maximum loss. Ali would not lose more when company closed down. That's limited liability. Okay, limited is an advantage. Agree, right? Is an advantage. Is an advantage to shareholders. Okay, now let's answer the C1 quickly. One difference between ordinary share and preference share. I make it a two difference question. Okay, assume that this is a question asking you for two differences. So I write two answers for you. You follow. Again, applying the table that you saw earlier in the notes there. Okay. Ordinary shares holders have voting rights. I know the question is asking about the shares, not the shareholders, but they are looking for the same answers as the difference between ordinary shareholders and preference shareholders. No worries, it's the same thing. Okay. Because I have done enough accounting exam, I know what they look for here. Okay. Even though they don't ask for shareholders, but they're talking about ordinary shares and preference shares. Okay, but they meant the same as shareholders. Okay. So preference shareholders do not have voting rights. Simple, easy to write for this. Yes, right? Okay. What is another difference you can talk about? The dividends. Okay, the dividends is something very easy to write in the exam. Variable okay, and then for preference shareholders, they receive fixed rate of dividend. Okay, finish. Okay, while you're still writing, I discuss the next one. Yeah, it's on the same page. Okay, you write while listening. Okay, let me check. Okay, fixed rate for preference do not have voting right. Have voting right variable. Okay, correct. Okay, now next one, preference shares and debentures. Okay, debentures. I have a part of the notes there that talks about debenture. It's in a table also. Later we see it. Okay, but let's answer this first. Okay, debentures means non-current liability. Non-current liability. Honestly speaking, I have not learned everything about debentures. Okay, I have not learned everything about debentures. For accountants, accountants only have to know that this is a non-current liability, and when you have debenture, you must pay interest. You must pay interest whenever you have debenture. Okay, it's a non-current liability. It's the same as long-term borrowing. Long-term borrowing. Now, two similarities. Can you say that one is NCL, another is part of equity? No. Okay, now let's try to talk about the fixed element, the fixed element of interest and the fixed element of the dividend that preference shareholders get. Okay, you write together with me. We talk about the fixed component. Both. The person who the person who lends money to the company is known as debenture holders. Okay, debenture holders are the lenders. Company is the borrower. Company borrows money from debenture holders. In return, debenture holders get interest. Debenture holders get interest. Receive fixed dividends and fixed interest respectively. Okay. So my point here, my similarity here is about the fixed reward that they get. Okay, the fixed reward that they get. Even though one is dividend and another is interest, but I'm referring to the fixed element. Okay, the fixed element. We can describe it this way: similarity. And then debenture holders also do not have voting rights. Among the three, ordinary shareholders, preference shareholders, and debenture holders, only ordinary shareholders have voting rights. Only ordinary shareholders have voting rights. Okay. So let's talk about that. Both of them don't have voting rights. I tell you the reason later. Okay. Usually I would tell my students what is the reason. What is the reason only ordinary shareholders have voting rights? Okay, let's write together this one. Okay, so when you're done writing, you let me know. Okay, and then we move on to other theory question. I want to expose you to enough theory question so that at the end of the day, you can see that it's not very difficult to answer the theory questions. Okay, okay, good, Joey. Later, when we are in the note session there, I will explain why ordinary shareholders have voting rights, but the other group of people don't have. Okay, let's wait for Jing Jing. Okay, I think I can explain now why ordinary shareholders need to vote, but preference shareholders and debenture holders don't need to vote. Okay, you agree, right? You agree that preference shareholders, they receive fixed dividends. Okay, preference shareholders, they receive fixed dividends. It doesn't matter company has done well or badly in a year. It doesn't matter company has done well or badly in a year. Preference shareholders always get fixed dividends. Agree? Okay. So do you think preference shareholders care how well the company has been doing? Do you think preference shareholders will care? Of course, they don't care. So I can also say that preference shareholders, they don't care who are the directors, right? They don't care who are the directors who run the company, right? Because whether the company has been doing well or badly, preference shareholders still get the fixed dividend. Okay, yeah. So they don't care who are the directors who run the company. Same goes to debenture holders. They get fixed interest every year, regardless of how well the company has been doing. So they also don't care who runs the company. Who cares? Who cares as to who run the company? Ordinary shareholders, they care because ordinary shareholders, they get variable rate of dividends. Okay, variable means it can be any percentage of dividend that ordinary shareholders get each year. Who would decide? Who would make a decision how much ordinary shareholders will get? It is the directors. Directors each year, they will do announcement as to how much dividend ordinary shareholders will get. If the company has done badly, then ordinary shareholders are likely to get very low level of dividends. It could be 0%. Okay, so my point is, how much ordinary shareholders will get for their dividends, it depends on, or you call it correlate. Yeah, it correlates to company's business performance. It correlates to company's business performance. If the company has done well in a year, then ordinary shareholders get high level of dividends. If it is bad, then it could be as low as 1 or 0% or 2%, very low percentage of dividend. Okay, so in that case, do you think that ordinary shareholders would care who run the company? Of course they care. That's why they need to have the voting rights. They need to have the voting rights. Every year in the meeting, they will vote as to who would become the directors to run the company because they care how well the company has been doing. That's why ordinary shareholders have voting rights. Preference shareholders, Debenture holders, they don't care because they always get the fixed reward. Okay, yeah, so that's the reason. Okay, now let's move on. We have a few more to do before we get back to the notes. You go to page number. Yeah, let me see if this is good. Okay, you come to here. There's one we can do here. Page 332. Page 332. Okay, 332, yeah. Okay, now you look at the D first. Suggest two disadvantages to existing ordinary shareholder. Existing ordinary shareholders, yeah. If funds are raised by issuing additional ordinary shares. Just now we saw the same question, remember? So it shows that how popular this question is in the exam. It could repeat coming out again in the new exam sitting. So just copy and paste on your own. Okay, we did the same question earlier. Now, next, I want to do this with you. Question C. Okay, this is between existing ordinary shareholders and debentures. Earlier, you saw questions about a situation between ordinary shareholder and preference share. Another one is between ordinary share and existing ordinary shareholder. Now we look at something between ordinary shareholder and debenture. This is a different question. So two disadvantages to the existing ordinary shareholders. First thing we can talk about is what we call it liquidation. Okay, liquidation. When company closes down, creditors will get back all their money first, right? Creditors first, then preference shareholders, then ordinary shareholders will get back their money. Debenture holders are creditors. Debenture holders are the lenders. Okay, debenture holders are the creditors, lenders. So they will get back their money first. Okay. My point is, later when we get back to the notes, we add this term. Okay, we add this term next to the flow chart there. Now let's write together quickly. Let's write together quickly. Here you write, during liquidation, okay, so this is the first point about liquidation. And now you try to think, whenever there are more liabilities, there are more loans, more interest that the company has to pay, right? So when more interest have to be paid, it's quite likely that ordinary shareholders will get lower dividends also. Try to imagine, company has so many borrowing, a company that has so many borrowings. That also means so many interest to pay, so much interest to pay every year, right? So after paying all the interest to the creditors, quite likely that ordinary shareholders would get a lower dividends because company could argue that we have so much interest to pay. So please bear with us. I will pay you lower dividends. Okay, to the ordinary shareholders. Okay, this is what I'm going to write. Then you write together. Ordinary there are more to learn to companies accounting again. In the future, if you really do a subject known as accounting, then you may have something about a company buying off another company. Okay, you will have something known as subsidiary company and so on. It's something very complex, but it's not within here. It's not within IGCSE because Okay, more interest need to be paid to the debenture holders. Okay, once you're done writing, let me know. We have to move on to the next page. So far, you see, we have been just looking at theory questions. Okay, theory part itself, it makes up a big percentage of this topic. Okay, a lot of theory in this topic. Okay, good, Joey. Okay, good, Cherry. Okay, good, Jingji. Okay, good, Hino. Now, let's continue. Okay, next page, we see a different question. 333. Okay, page 333. Okay, question A. State two differences between debentures and ordinary shares. You see, we have been seeing a lot of questions on those three things, right? Ordinary share, preference shares, and debentures, which is consistent with what I told you earlier at the beginning. They always ask you questions about the similarities and differences and how they affect each other among these three things. Okay, ordinary share, preference shares, and debentures. Now, two differences. Easy thing to write is voting rights. Okay, let's write together. Don't write. You write on your own. Okay, I'm just going to write the point form here, but you must write in full. Yeah, must write in full. So debenture, debenture holders don't have voting right. You complete the sentences yourself. Okay, ordinary shareholders, they have voting rights. Okay, agree? Now, second difference, you talk about debenture holders receive interest. Ordinary shareholders receive dividends. Okay, so that's the second difference. Very easy. Okay, debenture holders don't have voting rights. Ordinary shareholders have voting rights. Debenture holders receive interest. Ordinary shareholders receive dividend. Simple. Okay. Now let's see the next question. Okay, you write on your own, yeah, when you are free, if you are free. Then okay, here, next other kind of question you see here, page 338, page 338. Question F, state two features of debentures. Features means qualities, which also means characteristics. Okay, characteristics. That means you have to describe, okay, describe what debentures are and what are the characteristics of debentures. So before we write, you may read this first. CP Limited, okay, once again, company's question, wants to expand and requires $300,000. Considering raising funds from either issuing debentures or preference shares, don't worry, they won't ask you to make decision. Okay, they won't ask you to make decision. But in the future, if you study related subjects, then you have to make decision. Okay, two features, very easy. You can talk about the fixed interest. Debenture holders receive fixed interest. Secondly, you can talk about they don't have voting rights. Okay, if you want to write in short form, you go on and write, okay? But in the exam, you must write in full, okay? Full answers like what I have here. Now, question G is also something different, which we have never seen before. State two features of preference shares. State two features of preference shares. Okay, two features of preference shares. Let me write in short form this time, okay, to save time. But in the exam, make sure you write in full. Okay, preference shareholders, they don't have voting rights. They don't have the voting rights. And preference shareholders, they receive fixed dividends, right? They receive fixed dividends. You see, we have written a lot of points using ideas about voting and the dividends, right? Okay, these are easy points to write. Okay, no voting rights, receive fixed dividends. Next. Okay, you see this question? Page 344, page 344. You see, same question, right? But this time, three features. So just now, earlier, we talked about no voting, okay? No voting. And then another one, we talk about the fixed dividend, right? Fixed dividend. Okay, now, what is the third feature you may write? You may write about liquidation. Okay, liquidation. So you write during liquidation, you can say that preference shareholders have prior claim before ordinary shareholders. Prior claim means they can get back their money first. Okay, you get my idea? Okay, during liquidation, preference shareholders will have prior claim before ordinary shareholders. Okay, preference shareholders can get back their money first. Okay, so you complete the sentence yourself. Okay, now next page is a very recent question. Okay, 2019, very relevant, very relevant. Okay, so is it possible for such question to come out again? Yes, very possible. Okay, now 3 features of debentures. First, you can talk about debenture holders don't have voting rights. They receive fixed interest, And lastly, you can talk about once again talk about liquidation. During liquidation, debenture holders will have a prior claim before all shareholders. Okay, before all shareholders. SH, the short form SH that I keep writing, SH stand for shareholder. Okay, SH stand for shareholder. Okay, yeah, so this one easy. And then okay, now a different kind of question here. 350, page 350. State one reason why D Limited paid a dividend. Have you seen such question before earlier? No, right? Okay. Basically, here you can talk about the purpose of paying a dividend. The purpose of paying a dividend. Okay, so you write to reward shareholders for their invested fund. Okay, so why people want to buy shares in the first place? Of course, to earn money, right? So one way of earning money is getting dividends if the company has done well. Okay, to reward shareholders for their invested funds. Okay, yeah, I should have written, yeah. Now we move on. Reward shareholders for their invested funds. Okay, now get back to the notes. Let's get back to the notes. Okay, you go to page number 301, page 301. Here, you fill up the blanks. Just fill up the blanks, then you read on your own. These 4 terms, only their definitions are important in the exam. Their definitions are important in the exam. In real life, not important at all. Nobody would ask you what these 4 terms are. Definitions are here. You go through yourself, okay? Then you fill up the blank with me now. Here you write authorize. Here you write issue. Here you write call up. Here you write paid up. Okay, I give you 10 seconds. Okay, 10 seconds, you're right. There are more important things for me to see, to go through with you. Okay, 10 seconds. Okay, now this one you look at it yourself, very easy. Okay, you can look at the PDF with my annotation. Okay, this part is very easy about calculation of value and number of shares. Okay, and then debentures table, this one you read on your own. We just now did a lot of questions on debentures. Again, the blanks here, you fill up the blanks with my annotation from the PDF. And this page at the bottom here can cross off. This is no longer important. This is no longer important. And then here you write, yeah, this is important. You write, fill up the blank here. Total dividends to be deducted in the SOCIE. SOCIE stands for Statement of Changes in Equity, which we will see later. Okay, Statement of Changes in Equity is a big table. I believe you have seen before because SOCIE is one of the most important thing for the topic. Okay, later we will see. Now, but now you fill up the blank with me. You write for your information, dividends that you pay to the ordinary shareholders. There are two stages. There are two stages of dividends to be paid to the ordinary shareholders. One is known as interim dividends. Another is final dividends. Usually, I would explain using a long story why there are two types of dividends here. Okay, the two stages of dividends here, interim and final. But here, I want to save time, so I don't talk about it. Yeah, but don't worry, they will not ask you why there are two stages of dividends paid to the ordinary shareholders. Okay, and you must know in both interim and final dividends are paid to the ordinary shareholders. And you fill up the blanks with me here together. You write interim dividends for current year plus final dividend for previous year. Later, when you are looking at the SOCIE table with me, you have to deduct these two amounts of dividend. You have to deduct these two amounts of dividend from the SOCIE table. Okay, interim dividend for the current year, final dividend for the previous year. Okay, something to remember here is it is the final dividend for the previous year. Okay, later, usually I will explain, but here I cannot take the time to explain this one for you. Okay, so these two must remember. Later I show you a question. Then you would know what I mean. And this term is important, proposed dividends. Whenever you see the term proposed dividends, ignore that, okay? Don't include that in your answer. Proposed means suggested. Proposed means suggested. That means, remember, who makes the decision as to how much dividends paid to the ordinary shareholders? It is the directors. Directors are the people who would sit down together and to discuss how much dividends to be paid to the ordinary shareholders. Proposed means suggested, which means it is unconfirmed. So if you see any figure of proposed dividends, don't fall into this trap. Okay, don't take that figure. Proposed dividends, just ignore. Okay, because you should do nothing with it. No accounting entries should be made. Okay, so this one, remember, when you see proposed dividends, ignore. On another hand, if you see declare, then you should take that into account. You should record it in accounting. Later, I'll show you how to record. The one on the right, you can see payment of dividends to preference shareholders. They need to be deducted in the income statement. Deducted in the income statement after the debenture interest charges. Okay, later I show you the income statement where we deduct the preference share dividend. A conclusion here I can talk about is both interim dividends and final dividends that you pay to the ordinary shareholders, you minus in the SOCIE table, the statement of changes in equity table. For dividends that you pay to the preference shareholders, you minus it in the income statement. Okay, I show you soon. Okay, in a few pages later. This one you do yourself calculation, very easy. Now come to this page. This is how you present the income statement for a company. You must know the position of the dividends paid to the preference shareholders here. You fill up the blanks together with me on this page 304. Okay, let's see. You see an arrow pointing to here. Here we are going to write an expense that is only for a company. Okay, an expense that doesn't appear in sole traders income statement and partnerships income statement. It is the salary to directors, because only in a company you would have directors. That's why only for a company you have this expense, salaries to directors. Okay, you're right, salary to directors. And all the words same here mean you do it the same way as you usually do these parts. Okay, and then here you write profit from operations. Only for company's income statement you will have this line of profit from operations. It is also known as operating profits. It is also known as operating profits. Okay, and In between or profit for operations and profit for the year, you must know what are in between these two. First one, you write together with me. You must less means minus, right? The first item that comes after profit for operation must be interest first. Interest first. Interest for any loans, okay? Interest for debentures, interest for any loans, okay? Interest will come here first. Minus interest first, then only you minus dividends paid to preference shareholder. Dividends paid to preference shareholders. But I can tell you one fact, quite rarely you will see anything about preference share in the exam questions. Only once in a while you will see. So quite likely that you would only have interest here and without dividends paid to preference shareholder in the question. Dividends paid to preference shareholder. If you have, then you minus it here. So once again, let me repeat, yeah. Important thing to remember in a company's income statement is that you must have 3 levels of profit. The gross profit level, then the last one is always profit for the year, right? Then before profit for the year, you need to have profit for operations. And in between profit from operation and profit for the year, you can only have maximum these two things. Must minus interest first. If you have any interest on loan, then only followed by this one. Okay, this must come first. Then only this comes second, if there is any. Dividends paid to the preference shareholders, you minus it here. They will not ask you why you have these two items here. Why they won't ask you why you minus interest first, then only minus preference shareholders dividend. This is something outside the scope of IG. So if you want to learn the reason why you have this formatting, then you will see in the future. Okay, if you do accounting. Okay, so just remember the formatting here: minus interest, then minus dividend paid to preference shareholder. This is where you minus the preference shareholder dividend. What about dividends paid to the ordinary shareholders? Earlier we talked about it. We minus it in the SOCIE table, minus the ordinary shareholders dividend in SOCIE table. I show you now. Almost always you will see question on SOCIE. Okay, so you must know how to do the SOCIE table. I show you. Come to this page 305. Okay, later I explain this part again, where you have the blanks here, but we see the SOCIE table first. Okay, you still remember accounting equation? Accounting equation is A equal to C plus L. Agree? Okay, A equal to C plus L. And capital means the same as equity. Capital means the same as equity. But only for companies accounting, you use the word equity instead of capital. So that also means we can substitute the C with equity to become A equal to equity plus L. Okay, A equals to equity plus L. And for companies accounting, equity is made out of 4 components. Equity is made out of 4 components, and there are these 4. Okay, you write down. Equity is made out of 4 components. 1, 2, 3, 4. First one, you write ordinary share capital. Ordinary share capital. Second one, you write retained earnings. The meaning you read yourself, okay? Meaning you read yourself. First one, write ordinary share capital. Second one, you write retained earning. Third one, you write preference share capital. You write in short form first, you complete it later. Last one, you write general reserve. Okay, let me explain a bit about each of these 4 things, okay? Because I have to carry it to the table later. Ordinary shares capital means all the ordinary shares that you have issued. Preference share capital means all the preference shares that you have issued. Okay, but sometimes, most of the time, you don't have this. Most of the time, you don't have this in the exam, but it is still within the syllabus, so I must teach you. Whether it will come up in the future, I'm not sure. Okay, but you must know it's part of equity. These 4 items, sum them up, it becomes equity. Okay, equity means investment from owner. means the same as capital. Capital means investment from owner, right? Equity also means investment from owner. Okay, now retained earnings is important. You know what is earnings, right? Earning means profit. Okay, agree? Earnings means profit. How much you have earned. Okay, so what is meant by retain? Retain means you save it. Okay, you save it. So logically, retained earnings means that that's the place you keep all your profits. Agree? Okay, so you see the explanation here. Accumulation of all the profits. Profits here means all the profit for the year. Less profits earned. Of course, if you have a loss for the year, it will be minus from here also. Okay, so later when you see the SOCIE table, you will see profit for the year being added to retained earning. Minus less, you can see the word less, any ordinary dividends paid. Ordinary dividends means dividends paid to the ordinary shareholders. So this line is important. It tells you that when you see profit for the year, you plus it into retained earning. When you see dividends paid to ordinary shareholders, which are the interim and final dividend, you minus it from here. Okay, minus from the retained earning. What about general reserve? Reserve means you are saving something, right? You have heard of forest reserve. Forest reserve, I believe you have come across this term before. Forest reserve is about protecting the forest, right? Now, what is general reserve here? What are you trying to protect? You are trying to protect some form of funds. You are trying to protect some forms of fund in your business. Why do you want to protect your funds in your business? So you see, funds set aside is like in your daily life, you save money, right? Save money for your future, right? Save money for retirement in the future, right? So it's like the same thing here. You are putting aside some money, funds set aside from retained earnings. This one must remember. How do you generate general reserve? How do you come up with general reserve? You minus from retained earning. Then you plus it into the general reserve. Okay, and why do you do so? Why do you have to protect some money in your business? For certain business purposes. What are the certain business purposes? For example, maybe you want to expand your business in the future business expansion. Maybe you are saving money to buy over KFC. You are McDonald's. You are trying to buy over McDonald's to kill the competition. Okay, future expansion. Or you want to buy off other businesses. For example, you are Toyota. You are trying to buy off Honda in the future so that you own both company. Okay, or any other purposes. Okay, up to the company's decision in the future. Or you are saving money for maybe emergency use. Okay, for emergency use. So just like what you would do in your daily life, you save money for emergency use for future retirement. Okay, but here is about business. So we have other kind of examples. Okay, so that's general reserve minus from retained earning. Then you plus it into the general reserve. Okay. Now let's see the SOCIE table. You are going to see these 4 items, okay, in the SOCIE table. Here you see, next page. So I have explained in detail what is equity. Okay, equity is made out of the 4 components that you saw just now. Okay, the 4 components that you saw just now. Okay, that's equity. Combine all of them, you get equity. So let's try to learn how to read this table. In the exam, this table would be given to you, and they would ask you to fill up the blanks here. Okay, they will ask you to fill up the blanks here. So, as the term implies, statement of changes in equity. So what would you see in this table? Of course, the changes to all the 4 components. You are going to see the changes to ordinary share, changes to preference share, changes to this, changes to that. That's how they come up with the name statement of changes in equity. It shows to you the changes to these 4 components of the equity. And the changes are here. These are the changes. These are the changes during the year. Okay, now let's look at it one by one. First row of numbers, you have the opening balance. Opening means not opening a bag, not opening a can of Coca-Cola. Opening means beginning of the year. So opening balance means the remaining amount for these four components at the beginning of the year. Closing means at the year end, which shows to you the remaining amount for these four components at the year end. Okay. Now, the question would give you the opening balance for sure. Okay. All this will be given to you. So let's see the first change. First change is profit for the year. Where should you show profit for the year? Just now I mentioned before, you show it in the retained earning. Okay, so you show it here. It depends on what figure is in the question. Okay, I just write XXX here. Okay, you see the question, see what is the profit for the year, then you write it here. Okay. Issue of ordinary shares, which means you sell off more shares to raise funds. The figure you write it here. Easy. It's going to increase your ordinary share capital. Next one, common mistake made by the students. They forget how to generate the general reserve. They have forgotten how the general reserve comes about. Must remember, minus from the retained earning. Okay, so you see, minus from the retained earning, plus it into the general reserve. We talked about it earlier, right? Okay, minus from retained earning, plus it into the general reserve. And ordinary share dividend paid. For this one, sometimes they have two descriptions for it. Okay, they split it into interim and final dividends, and you must know what numbers to take. For interim dividend, you pick the current year's interim dividend. Okay, pick the current year's interim dividend. For final dividend, you must pick the final dividend related to the previous year. Final dividend related to the previous year. Okay, let me write properly. Final dividend related to the previous year. Okay, you go through some questions at the back, you would realize what I mean. Okay, ordinary share dividend paid, it can be split into two: interim dividend for the current year, final dividend related to the previous year. You minus both of them from here, retained earning. Okay, minus from here. And then for those areas where you don't have number, just put dashes here and there will do. Okay, just put dashes here and there will do, or you keep them blank, Then last column is easy. Just total up vertically downward, total up vertically downward, total up, total up. The total column on the right, you total up horizontally, total up horizontally. Get what I mean? Okay. Now be careful with the last number that you calculate, which is the number at the bottom right corner here. Common mistake made by students. You see, this figure, you can calculate it with two methods. First method is you calculate it vertically downward. You total up vertically downward. Second method is you total up horizontally to the right. You must get the same figure. Many students, they just calculate it one time using either of the two directions. But I advise you, please calculate it two times. Calculate that last figure here two times. First time vertically downward, second time horizontally to the right, to ensure that you get the same figure. Then only you are safe. Okay, then only you are safe. Okay, so that's how SOCIE table must know how to do. Okay, must know how to do. Okay, before I dismiss, you fill up the blanks here. You write income statement here. Then you write SOCIE. Then you write SOFP. Okay, must know the sequence. Okay, prepare income statement first, then you prepare SOCIE, then you prepare SOFP. You try to think, what if it is a manufacturing business in a company? What if your company is running a manufacturing business? Last week we talked about manufacturing business, right? Imagine if you are a company that runs a manufacturing business, then they can have questions about manufacturing also. So you must know how it links to that manufacturing. If it is a manufacturing business, then before preparing income statement, you have to prepare what? You have to prepare manufacturing account. Make sense? Okay. So though I've not seen questions like this before where they give you both manufacturing and company, but This is something possible to come out in the exam. Something possible to come out in the exam. Okay, prepare manufacturing account first, then income statement, then SOCIE, then SOFP. Okay, so that's it for today. Okay, if you have questions from time to time, okay, once again, ensure that you try some questions at the back. Okay, especially those that are the latest year's one. Okay, 2019, 2020, or 2018. Okay, those questions are more relevant. The later, the better. Okay, so have a nice day, everyone. If you have more questions, then you let me know from time to time. Next week, we do partnership. Okay, so have a nice day, everyone. Bye-bye.
Bye bye.
No problem.